I've had a lot of experience reading what other people say about capital allocation, and I find that there is a lot of fuzzy thinking about it. People generally give too much importance to the signal or too much importance to the supposed form of the return that they're getting, and they don't think enough about what is the company's job. The company's job is to create value, first and foremost. So any investment they do should be designed, they should first spend all the money they can to earn excess returns above the cost of their capital. After that, when they have excess cash, they should pay it out, because when they hold excess cash, it effectively dampens their returns. 0% return over a course of a year is not meeting the cost of capital. If you just have cash in your balance sheet, right now you're getting almost nothing. So I want to see a company pay out excess cash. That's the first decision. The second decision, how to do it, is really much less important. Buying back shares with excess cash is, I was going to say, virtually always a good option. It may be better to pay a dividend if the stock is overvalued, because then you're basically treating all shareholders equally. You're making them all sell a certain amount of the company. They pay out 5%, the stock goes down 5%. You've just converted stock to cash. It's a sale for you, effectively. In a buyback, you get to choose whether you are going to participate or not. If you don't sell and the stock goes down, you've made a bad decision. If you sell and the stock goes up, you've made a bad decision. So the challenge for the investor is to value the company. It's not about whether a buyback's going to bail me out or not. It's, I need to value the company. That's my job as a professional investor. So management can decide to pay out. As a shareholder, by definition, I think the stock's undervalued. So I would rather have a buyback. It's not a taxable event for me. I don't have to rebuy the shares that they sell for me effectively by giving me a dividend. So I prefer a buyback. Virtually every time as a shareholder, I will prefer that. And then I just separately have to do my job of valuing the company properly. One place where we often see questionable budgeting decisions is in technology companies. Technology companies in general hold too much cash. They do need some cash to buffer against downturns. You know, they're a very economically sensitive industry, so we understand holding cash for a downturn. But when you're Apple and you've built up $150 billion in cash, there is no downturn that's going to cost you that much. You need to pay some of that money out if you don't have an investment to make with it. And apart from buying General Electric, I don't know what investment they would make with it. It's way too much money. So Carl Icahn came along and told them it'd be more shareholder friendly to pay it out than to keep it on your balance sheet, and eventually they agreed in small part. So not all of the money, but some of the money would come back to shareholders. That is actually a value creating event for them, because they're no longer holding the capital and not earning a return. They're now giving it back to shareholders, and they can go invest it in bonds or stocks or whatever else that can earn a return.